Picture this, it's tax season, and while everyone else is stressed, you're cool as a cucumber. Why? Because you've mastered the art of quarterly taxes. Sound impossible? It's not. In fact, by the end of this video, you'll know exactly who needs to pay, how to do it, and what happens if you don't. Ready to transform your tax game? Let's talk about quarterly taxes, your secret weapon against the annual tax panic. Think about it. No more frantic receipt hunting or last-minute calculations. By the time we're done here, you'll understand who needs to pay, how to do it, and why it's so important. Here's where things get real. Ignoring quarterly taxes isn't just stressful, it can hit your wallet hard. But don't worry, we're about to turn you from a tax novice into a quarterly tax pro. Imagine facing tax season with confidence, knowing you've already paid what you owe. That's the power of mastering quarterly taxes. Sound good? Let's get started. Now that you're feeling pumped about mastering quarterly taxes, let's dive into who's actually on the hook. You might think it's just big business owners, but what if I told you that your side gig could land you on the IRS's quarterly VIP list? The truth is, more people than you'd expect are required to pay these taxes. Are you one of them? Let's find out. First up, the usual suspects: independent contractors, sole proprietors, and partnership members. If you're self-employed or running your own business, chances are you're already familiar with the quarterly tax dance. But here's where it gets interesting. Even if you have a regular job, you might still need to join the quarterly tax party. So, how do you know if you're invited? Enter the $1,000 rule. It's not as scary as it sounds, but it's crucial to understand. If you expect to owe more than $1,000 in taxes after subtracting withholding and tax credits, congratulations! You're officially in the quarterly tax club. Don't worry, it's not as exclusive as it sounds. Let's break it down with an example. Say you've got a full-time job, but you also make some extra cash on the side through freelance work or investments. If that additional income pushes your tax bill over the $1,000 threshold, you'll need to start thinking quarterly. But wait, there's more. The IRS has another trick up its sleeve. If your withholding and tax credits are less than either 90% of your estimated tax liability for the current year or 100% of the previous year's tax liability, you're in. And for you high earners out there, the rules get a bit trickier, so pay extra attention. Now, I know what you're thinking. What about farmers and fishers? Well, the IRS has a special place in its heart for you too. If at least 2/3 of your income comes from farming or fishing, you've got a different set of rules. You'll need to pay either 2/3 of your current year tax or 100% of your prior year tax. Here's a pro tip. If your income fluctuates throughout the year, I'm looking at you, gig workers, and seasonal businesses, you can actually adjust your quarterly payments to match those changes. It's like having a tax payment that breathes with your business. Pretty cool, right? So, are you on the list? If you're self-employed, have a side hustle, or significant non-wage income, chances are you're in the quarterly tax club. But don't panic. Knowing is half the battle. And trust me, it's better to be in the know than to get a surprise letter from the IRS. Think you've got quarterly taxes figured out? Hold that thought. The IRS has a crystal ball and they expect you to use it too. Can you predict your annual income down to the dollar? Because that's exactly what you need to do to stay in their good graces. Welcome to the world of pay-as-you-go taxes, where the IRS wants you to chip in throughout the year instead of dropping a lump sum in April. But why? Simple. It keeps the government's cash flow steady and prevents you from getting hit with a massive bill all at once. Here's where it gets tricky. You need to estimate your annual income and taxes owed. It's like being asked to predict the weather for the entire year in January. But don't sweat it. The IRS isn't expecting you to be psychic. They've got something called safe harbor rules to give you a bit of wiggle room. Let's break it down. To avoid penalties, you need to pay either 90% of your current year's tax liability or 100% of your previous year's tax liability. Think of it as your get-out-of-jail-free card. But wait, there's a twist for you high rollers out there. If your adjusted gross income exceeds $150,000, or $75,000 if you're married and filing separately, that 100% jumps to 110%. The IRS figures if you're making that much, you can afford to be a little more precise. Now, what exactly are you paying? It's not just income tax on your profits. If you're self-employed, you're also on the hook for self-employment tax. That's right, you're paying both halves of Social Security and Medicare taxes. Fun, right? So how do you crunch these numbers? The IRS, in all its generosity, provides Form 1040 ES. It's got a worksheet that'll help you calculate your estimated tax payments based on your expected income and deductions. Start with your expected annual gross income, subtract your business expenses and any eligible deductions, and voila, you've got your estimated taxable income. Here's a pro tip. Divide your estimated tax by 4. That's your quarterly payment. But remember, if your income fluctuates throughout the year, I'm looking at you, seasonal businesses, you can adjust your payments accordingly. It's like having a tax payment that breathes with your business. And here's a little-known secret. If you overpaid last year, you can apply that overpayment to this year's estimated taxes. It's like finding money in your coat pocket, but instead of buying coffee, you're reducing your tax burden. Now that you've crunched the numbers, it's time for the moment of truth. Ever wondered how the IRS prefers to receive your hard-earned cash? Spoiler alert, they're not fans of briefcases full of bills. In fact, they've got a system that's so streamlined, it might just make you feel like a tax-paying superhero. Enter the Electronic Federal Tax Payment System, or EFTPS for short. It's like online banking, but for your taxes. But before we dive into the how, let's talk about the when. Timing is everything when it comes to quarterly taxes, and getting these dates wrong could cost you. For 2023, mark your calendars for April 18th, June 15th, September 15th, and January 16th, 2024. Planning ahead for 2024? Your dates are April 15th, June 17th, September 16th, and January 15th, 2025. Miss these, and you might find yourself on the wrong side of an underpayment penalty. So, how do you actually make these payments? The IRS has made it surprisingly easy. First, you'll need to set up an account on the EFTPS website. It's free, but it does take a few days to process, so don't wait until the last minute. Once you're set up, you can schedule payments in advance or make them on the due date. You can even set up recurring payments if you're feeling particularly organized. Here's a step-by-step guide to make your first payment. 1. Log into your EFTPS account. 2. Select Make a Payment from the main menu. 3. Choose Estimated Tax as the tax type. 4. Enter the tax year and payment amount. 5. Select your payment date. Remember those important dates we talked about. Point 6. Review and submit your payment. It's that simple. No stamps, no envelopes, no trips to the post office. Just a few clicks and you're done. Not a fan of online payments? The IRS hasn't forgotten about you. You can still use good old-fashioned paper forms. They'll send you a booklet with payment vouchers, or you can download Form 1040 ES from their website. Just fill it out and mail it in with your check or money order. Here's a pro tip. If your income changes significantly during the year, you can adjust your quarterly payments. Got a big new contract? Increase your next payment. Lose a major client? You might be able to reduce your payment. The IRS allows for these adjustments, so you're not locked into a fixed amount all year. And here's another little-known secret. If you overpay your quarterly taxes, you don't have to wait for a refund. You can apply that overpayment to your estimated taxes for the current year. It's like finding money in your coat pocket, but instead of buying coffee, you're reducing your tax burden. Let's recap what we've learned. If you're self-employed, have a side hustle, or significant non-wage income, you're likely in the quarterly tax club. Calculate your estimated taxes, divide by 4, and mark those payment dates on your calendar. The EFTPS is your new best friend for easy online payments. Now, here's the real transformation. Mastering quarterly taxes can transform your tax experience, allowing you to avoid the panic associated with tax season. No more frantic receipt hunting or sleepless nights worrying about IRS penalties. Instead, you're taking control of your financial future. Think about it. By consistently making quarterly payments, you can achieve peace of mind, knowing that you are compliant with IRS requirements and managing your tax obligations effectively. So, what are you waiting for? It's time to shift from feeling overwhelmed to feeling confident. Your future self will thank you for this tax transformation.